Now, stock options can sound like a very scary and risky thing to do, like going to a casino and gambling, or if you read crazy stories of people doing terrible things on Reddit or Wall Street bets. But if you understand this strategy and this skill very well, it's a game changer. Stay tuned. What's up, Fruitful investors? I hope you're doing well. On this channel, we discuss all things financial, real estate, stocks, and crypto. And in this video, I'm gonna share with you my personal, what I think, a very, very safe and boring stock option strategy. Pretty much as boring as it gets, but it can make you some predictable money. So before I get into that strategy, let's talk about the differences between buying stocks typically and doing stock options, because some people get confused with this. I know I did when I started off. I had no idea what even both were. Okay, so stocks is your typical strategy. You know, you're buying Apple at 140, you're buying a bunch of shares, you're gonna hold on to it, and you're gonna hope that the market goes up, and you're gonna sell it for more, maybe around 150, 160 a share. Very boring, kind of like a real estate investing strategy. We're just buying a rental property, holding on to it, waiting for time to kind of happen, and the market typically, usually always goes up, especially if you're buying good companies, and then you sell it at a later date. Pretty simple, pretty straightforward. But you only make money one way, through appreciation. Basically, in real estate terms, when the stock appreciates in value and you sell it, you make money that way. With stock options, we can make money a bunch of different ways, and there's so many stock option strategies. But I'm gonna share with you mine, which is a put selling strategy, specifically selling put spreads. That's kind of my bread and butter and kind of what I stay to and focus on. So in a nutshell, to explain what stock options are before we get into that nerdy, boring strategy, that's why we like it. Stock options, the best way I can tell somebody for this strategy that I'm doing is, let's say Joe buys a bunch of Apple shares, right? And he only has like 10,000 bucks and he's investing 8,000, and his wife finds out and she says, do not lose all of our money. Whatever you do, don't lose all of our money. So Joe, the investor who's terrified of losing his money, what he's gonna do is buy an insurance policy from me, right? So for example, I'm gonna say, Joe, the shares for Apple are currently at 140. If they happen to drop to 120 in the next 60 days, I'll buy all of your shares from you at 120. But you gotta pay me 500 bucks for this insurance policy that I'm offering you. Now, if Apple doesn't go to 120 and it stays at 140, 139, 138, or drops all the way down to 121, I keep that 500 bucks. Sorry about your luck. That's how insurance works. So that's what I'm doing. I'm offering insurance policies for stocks that if they go down to a certain number, I will buy them all from you. Now, what I'm doing is I'm playing with very, very safe stocks that typically don't drop all that much. And I'm going what's called way out of the money, which I'll explain to you in great detail. We're gonna jump into my phone. I'm gonna show you exactly how to do this in Interactive Brokers, which is the program and the broker that I use. But anyway, that's what I'm doing. I'm going way out of the money. And that typically never happens. Why? Stock market typically over time always goes up, especially on the boring value or classic stocks you've probably always heard of that you've never thought to even invest in, kind of like me. Those stocks typically always go up. Now, there are dips and valleys along the way, but like I said, long term, they typically always go up. So for me, I'm really only trading 2 ETFs. And before I tell you those, an ETF is an exchange traded fund. So what that means is it's a combination or a pool of a number of stocks, kind of like a mutual fund. But you can trade it like a single stock, like I invested in Apple or Microsoft or Tesla or whatever, but I'm investing in a number of several hundred companies sometimes. So again, it's very boring, because if Apple, goes for a shit, or if Microsoft goes for a shit, not really a big deal. I'm investing in 499 other companies. So yeah, Microsoft had a bad earnings report or a bad couple months, no big deal. It's not really gonna affect my stock. Whereas if you only invested in Microsoft and they took a shit, they did something stupid, if you invest in Facebook and Mark Zuckerberg does something stupid, he gets caught hitting his girlfriend or something, I don't know, something crazy, right? That has nothing to do with stock market, but whatever he does in his personal life will affect his stock. That's what I don't like. I don't like investing in these risky things that I don't really have control in. That's why I like real estate so much, and I'm easing up to the stock market, which you really have like no control, but I want as much control as possible. So that's why I invest only in 2 ETFs. Number one is the SPY, which is the S&P 500 exchange traded fund. So I'm investing in 500 companies. I'm sure you've heard of the S&P 500. Your grandpa probably said, you should put your money in the S&P 500. And you're like, shut up, grandpa. That sounds stupid, right? I'm gonna do Bitcoin, right? Well, that's easy, very boring money, which is what I like. That's what I like with my real estate strategy, my crypto strategy, believe it or not. Yes, crypto. I want baby, and boring as possible because I don't like surprises. So I invest mainly like 80% of my put spreads are on SPY, S&P 500. And then I also invest in the triple QQQ, which is the 100 tech companies from the NASDAQ. So it's pretty much the NASDAQ traded fund in the QQQ, but again, you can trade it as if it was a single stock. So that's why I like it. So to break it down real quick, I'll go over my notes here. The S&P 500, the top 10 companies, you can see Apple is the biggest one at 5.97% of the S&P 500 ETF. Microsoft taking up a whole share of 5.81, Amazon 3.8. You can see the rest here on the screen. So the top 10 companies make up the majority, the biggest weight of it, and the other 490 companies make up the rest of it, right? So it's not evenly distributed. The top 10 are the biggest movers, the safest companies in America, you can say. They're leading the pack. They take up the most share of it, but not all of it, okay? And then we'll jump over to the triple Qs, right? We got Apple, again, number one. They're both number one on these ETFs. However, you can see with the triple Qs, Apple takes a bigger share of it, 10.99, almost 11% of that ETF. Microsoft, almost 10%, Amazon, 8.3. So the top 10 you can see are very, very similar between Q and SPY, but the allocations of percentages are a little different. Okay, so ETFs, why I like them as well is they're designed literally to always go up. Because for the S&P 500, for example, it's a top 500 companies in the United States. If a company starts doing bad, it starts dropping down the list and eventually gets knocked off the list and replaced with another company that's doing well, that's having good earnings reports, that's selling products, that's actually doing good things in the economy. So it is literally designed to go up. And when I heard someone say that, I forget who it was, someone told me that these ETFs are literally designed. The S&P 500 is literally designed to mostly to always go up. Dude, why would you want to invest in anything else? I get it, right? Tesla, Facebook, it's cool, it's trendy. I don't invest in any single stock. I just don't. Because like I said earlier, if Mark Zuckerberg does something stupid, if Jeff Bezos says something stupid, which he always does, if he Elon Musk, better yet, if he says something stupid on Twitter, his stock immediately takes a tumble. Why? It has nothing to do with his company. Tesla's still selling amazing cars all the time. What does it matter if Elon Musk says something, right? I just hate how the stock market is set up that way. That's why I personally never invest in a single company. Anyway, before I start boring you, let's jump into my phone now and I'll show you very quickly how this works, how this strategy is making me a ton of money. You're gonna see it right here. Let's jump in. All right, guys, so we're here in my interactive brokers. So I'm gonna click on SPY. Like I said, that's my number one bread and butter, baby. So you can see right here on the lower right, yeah, your lower right, you can see you can just buy the stock. On the left, you can just sell the stock. That's what 99% of people do. They just buy and sell the stocks. Boring, boring, boring. You can see up here on the top, you see options, right? That's where we play. That's where we do our thing. So if you click on options, right, so we got a date at the top here. See this bar moving? We got October 15th, October 18th, October 20th. I like to go about 45 to 60 days out. Why? It gives us a lot of time. If the market does take a shit, we typically have time to roll the trade or get out of the trade. I'll explain that in future videos or maybe in this video real quick. And the market, especially ETFs, typically go up over time. So some people do the weekly SPY or the daily SPY or day trading. You've probably heard of that. I don't like doing that. Again, too risky. Things can go wrong. I like time. Time on our side is good when it comes to investing in long term. So you can see on the bar here. So today is October 15th, somewhere like that. I don't know what day it is, man. Entrepreneur problems. So I'm gonna shoot over to November 19th. It's about 45 days, give or take. So we can see on the top here, SPY is currently trading at 434. That's what it's trading at. So if I scroll down, you can see right here where these kind of things diverge in the middle. The SPY is currently trading at 434. Now I like to go 10 to 15 to maybe even 16% out of the money. So what out of the money means, I'm gonna go lower than what the stock's trading at by 10 to 15%. So I'm gonna shoot, you can see my phone here, I'm gonna shoot all the way down to about 380. That's where I wanna play. That's pretty boring right now. The odds of the S&P 500 exchange traded fund SPY dropping all the way down to 380 by November 19th, it can happen, of course it can happen, but it would take something really bad to happen. Another coronavirus, another, I shouldn't have said that word on YouTube. Like a bomb hitting the earth. Like it would take something really bad for SPY to go down this low. Again, it can happen, but very, 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 very unlikely. And if it does, we have ways to mitigate our risk and mitigate our losses. But 99% of the time, literally, I'm gonna win. Watch this. So what I'm gonna do is I'm gonna sell a put at 380, which means if SPY goes down to 380, I automatically have to buy the shares at 380, but I don't wanna buy that many shares. I don't wanna actually own the stocks. I just wanna do the cash flow game of stock options. So what I'm gonna do, I'm gonna sell the 380 and I'm gonna automatically buy the 375. So if the stock shoots down way below it, something terrible happens, Armageddon, the stock goes to like zero, I'm mitigating my loss. I have a maximum loss. Why? I'm buying, I know it's confusing, so I'm selling a put at 380, which actually means I'm buying the stocks at 380. It's confusing, we'll explain that. And then if it shoots down to even lower, I'm buying a put, which means I'm actually selling the stock at 375. You have to watch a lot of videos if I'm confusing you. This took me so long to kind of figure out, but the more you play with it and the more you can do paper trading, which is a simulated account, which I highly recommend, you'll pick it up. You doing this for a couple of weeks, you'll get this, hands down. It's a very easy strategy. Anyway, so we go back to the phone here. So I'm actually gonna sell the 380 and I'm gonna buy the 375. So this gives me a credit of 18 cents. So I'm gonna go ahead and order this. Now, with stock options, you have to buy one contract, which is automatically 100 shares. So with stocks, normal buying, I can buy 1 share of Apple, 2 shares, 5 shares. With stock options, one contract automatically means 100 shares. Okay, so this is where a lot of people get into trouble and because they don't know how stock options work. They sell a naked put at 380 for SPY. It's not gonna go down to 380. And then it does, they have to buy 100 shares. If they did 2 contracts, 200 shares. If you do what I do, which is 100 contracts, you have to buy 1,000 shares. Okay, 1,000 shares times 430 bucks per share, that's dirty. All right, so we go down to the number of contracts here. So we got the 1 contract. Now what I like to do is play with 100 contracts per deal I'm doing here, which means I get 18 cents per contract. To make it easier, go down here and see a preview. You can see how much exactly you're gonna get paid. So we see here, I'm gonna get paid $1,800, but I have to put up $62,000. Okay, so if I do the math on that, let's do it right here. I'm gonna make 1,800 bucks divided by 63,000 times 100. That is 2.85 cash on cash return in 60 days. So about 1.5% cash on cash return in a month. And we never really wait the whole 2 months. I'll share with you that in a second. So that's basically it. And you can see here at the top here, there's a 99% chance that I'm gonna make this money and SPY is not gonna go down to 380 or even lower. So that's the way I like to play. A lot of people play way more aggressive. Maybe they would do this put spread at 415 or 420, right? SPY is currently at 440, 434 kind of thing. Too risky. You get paid way more money, but in this case, I get paid what I like to think guaranteed money, right? This is 1,800 USD. Pretty much 99% chance I'm gonna get this, but I have to put up 63,000 Canadian of my money. If you guys did it purely USD, it'd be 50,000 for you. But that's pretty much a strategy in a nutshell. It's a put spread, right? So I'm limiting my loss. I can only lose 62,000. If SPY does shoot down below 375, I lose my 62,000 bucks. But like I said, we don't wait that long. We watch the market. As soon as the market, so if I'm 15% out the money and the market starts to go down 6%, maybe 7% in the past couple of days because something crazy happens, I'm gonna sell that spread, which you can get out of these anytime you want. I can get out of it and maybe I'll lose 20 grand, right? That sucks. But at least I didn't lose the full 60 grand. And I'm making this all the time on many deals. So it kind of pays for itself in the end. It's a very, very boring strategy. And like I said, I'm trading with right now about 600 grand Canadian with this exact strategy with the stock options. And it's making me about 12,000 USD every single month. 99% chance I get that 12,000 to 15,000 USD every single month with my 600 grand Canadian. So fantastic strategy. Lots more to this. I want to make a quick video about kind of what my main strategy is. Like I said, this could be a whole masterclass. I could literally spend 40 hours talking about this, and I will in these YouTube videos coming up, but that's enough for this video. That's my personal, very, very safe, I think, my very, very safe put selling strategy in stock options. I hope you learned something. I hope you got some value. If you did, smash that like button, hit that subscribe button so we can see you in the next video.